Welcome. This is the November webinar for Principal Wealth. I am Julina Ogilvie, partner and wealth advisor, and I am joined by Bob Paolucci, our founder and CEO. Bob, welcome.
Good morning.
Good morning. The title this month is Changing of the Guard. The election is past us. Decisions have been made, and now we have all of these new questions that have arisen as to where do we go from here, and you are going to help walk through these with us.
I think you'll provide some assistance as well, Julina. But yes,
Okay.
let's just get into it.
Sounds good. We have our agenda that has been following the cadence of talking about the markets and then the economy and policy, and then what we bucket is everything else, where we will talk a little more about the election.
Yeah, we will certainly get into, where we are, the current setting, the backdrop, which I just want to give you a hint right now is more important than, potential changes to policy, leadership, especially when we talk about the capital markets, right? The capital markets care about liquidity in the system, which means, cash on the sidelines. There's a ton of it, more than ever in history. It cares about the current level and direction of interest rates, which is closer to normal and getting lower. It cares about the current level and trajectory of inflation, which, if measured today, is low. And our best guess is a little lower, pretty consistently here. It cares about corporate balance sheet health. There's a lot to that, but balance sheets are quite good when measured pretty broadly throughout the capital markets. It cares about shareholder-friendly activity, which is another sign of health, right? It's our dividends being paid and increased versus being cut or suspended. We have dividends being paid and increased. Are companies buying back their own shares, which is an interesting way of saying companies have so much cash, they're handing out more dividends, pursuing growth opportunities, and they still have money to buy back their own shares.
Yeah.
So the foundational setup, right, in addition to the economy, where you have near full employment, it's a little off where it was maybe a year ago, but you have near full employment, you have pretty broad participation in the economy. And you have a little bit more manufacturing than we've had over the past couple of years. So you have a solid foundation, which I can tell you we should probably stop talking about politics at this point, but outweighs the political scene pretty significantly, especially this go round.
Yeah.
So, but we'll get into it. We'll talk about things like the next 6 months or the best 6 months. The bull market had a birthday. The Dow is changing face, that old index, that old irrelevant index. We'll give you other signs of good health and strength in the markets and the economy. We'll talk about deficits because we should, and we will, end with just some basic election stuff.
Okay.
So let's get right into it.
Yeah, I think that's a solid foundation, especially for the first slide, which shows such a tremendous performance this year, which candidly has some people nervous.
Yeah, look, I don't love these sensational titles, but S&P 500 performance, which is in English the U.S. market, best year in the 21st century. Yeah, so far. So far, our guess is it probably will end up being the best year in the 21st century.
Yeah.
Um, at a time where, again, so many investors are sitting in cash,
Yes, which we
right?
which we will get to.
Yeah, what
And
what a what a what a bizarre indicator. When you
yeah,
see peak cash, understand that returns are probably going to be sensational for a long period of time.
yeah.
But yeah, we are on track to have the best year in the 21st century. True.
And then the question is, of course, where do we go from here? But there's some
Where do we go
interesting
from here?
points.
Well, Julina, how about this slide? The next 6 months are the setup here, where we are forward usually is the best period of time to invest money, with the average change historically being 7.71% over the next 6 months, and a hit rate or a positive rate of 77% higher. So 77% of the time, this 6 month period is higher. The second and third best actually start in the same quarter, October and December. So you have, it starts now or last month or next month going forward 6 months. There, it's all good historically. We don't see that changing. It doesn't mean there won't be a down month or two or three, but when measured over six, and you really shouldn't even measure that short term, but let's do it. Measured over 6 months, this upcoming period tends to be quite well.
Yeah. There's a trend. We have a solid, strong market, and we're in a bull market.
Yeah, happy anniversary,
Our
Julina.
bull market, by the way, is the little red line. Let's start there.
Yeah, so you got to zoom in to see it, of course, but there's a red line that is tracking the bull market, and there it is, right above two. It's 2 years old, and you can see prior bull markets last longer, and in a few cases significantly longer.
Yes.
The average length of a bull market, you could see if you really measure it, is right around 8 years, 9 years or so.
Right.
When you average it out, we take close looks at prior bull markets, and it is the foundational elements that we just talked about that help shape and or end bull markets. And bull markets will end when there's no liquidity, no cash on the sideline, dividends are being suspended, there are no buybacks, interest rates are high and rising, banks aren't lending, there's a lot of people unemployed, right? That sounds like a recession. That sounds like the backdrop for the capital markets is not good. Yeah, that's right. That's exactly what that says. These other bull markets had something in common. You had low rates or lowering rates. You had low inflation or lowering inflation. You had lots of liquidity. You had the financial system willing to lend. So, lots of liquidity, and you had corporate balance sheets in many cases either in good shape or improving shape. And that's exactly what we have. So if you look at the longer bull markets, the setup was almost identical to the setup, the foundational setup that we have now. I could argue that the setup we have today might be better than any setup in history. Right now, look, a lot of that has to do with the excessive fiscal injection that we've had into the various markets, household bank accounts, business bank accounts. Yeah, I mean, but that's where we are. We can't take it back. That's where we are. The setup is quite good. The price to pay is we have an incredible amount of government debt, but the setup for the capital markets is very, very, very good. And we think we will be wishing it a happy third, fourth, fifth, sixth, seventh, eighth, ninth, and even 10th anniversary. But more to come on that as time passes.
This could very well be just the beginning. And it's not to say you don't have volatility along the way,
Yeah.
but this could be just the beginning phase. So
Right.
thank you.
Yep.
And this next slide I find so interesting because the media loves to focus on the Dow as the quote unquote market.
Yeah. So when we
There's a
talk about the
change.
U.S. stock market, it's the S&P 500, right? It's the 500 largest publicly traded companies by market cap, and there's some other qualifiers to it, but that's roughly what it is. Um, that's the one you follow. It has depth. It touches many sectors. It touches many companies in many sectors. It's a good measurement of the U.S. publicly traded market, generally speaking. The Dow, which is the big number, the big price index, has only 30 stocks in it, and they try to do a good job of representing the current times, the better market leaders in the industries. They don't really get into the sub industries. It's just the industries top level. But again, people follow this because it's an enormous number. You shouldn't really follow the Dow. You should pay attention to the S&P. But we mention this because the Dow is going through a makeover, and they kicked out Intel and Dow Chemical, not to be confused with Dow Jones, Dow Chemical.
Mhm.
So Dow kicked out Dow and Intel, and in comes Nvidia and Sherwin-Williams. Now, one thing that you could just see on this page here is Nvidia is just about the largest company in the world, roughly tied with Apple, depends on the day. Nvidia goes into the Dow and it has a tiny weight, right? A
2%.
2% weight. Sherwin-Williams, you know, the paint company, and they do other things, don't get me wrong, but they have a weight that is more than two times Nvidia.
Nvidia. Yeah.
So it
Why?
tells you, gives you a hint into the relevance of this index. And don't get me wrong, over a long period of time versus the S&P, they're close. Over short periods of time, there's a pretty significant
Not so
difference.
much.
so here you go. It's happening today. We're filming this on the 8th of November.
Yeah.
It's actually happening as we speak. So,
Yeah. And we talk a lot about earnings because that is a future driver of growth for the market.
yeah, and so are expectations, right? So earnings are up, and expectations are up as well. And one thing on this chart, we tend to fly through this chart, but when you look at the out quarters, you get into, you know, midway through 2025 and towards the end of 2025, you see a flip on the expected earnings growth from, large cap doing well, continuing to do well, but small caps um, finding some energy. So expected earnings, looking through Q4 of 24 is just about 6 to 7%. You go out to Q4 of 25, the expectation is 20+% earnings growth. I mean, that's a combination of analyst expectations based on the CEO and CFO of these companies' expectations. So I would say it's in their best interest, generally speaking, to give guidance if you're the CFO or CEO that you can meet pretty easily, right? Which is why markets continue to go higher, because the earnings expectations, the forecast by the companies themselves, are a little hedged. They want to jump over the hurdle. They don't want to negatively surprise the market or you, the investor, because there's some risk there, not only to their jobs but to the market cap of the company, the board, you know, employing their people. So they put out these expectations, and then analysts, you know, play with them a little bit. They make them a little higher, a little bit lower, but ultimately the generic forecasts are quite higher for some time here. So that's a very good thing.
Yeah, and we announced in the last webinar how the earnings expectations going forward in the S&P are not going to be reliant on just the Magnificent Seven. It will be more broad-based.
Yeah.
And again, we're also looking at the transition now into small caps going forward. And I think this is one of those compelling reasons as to why we lean in our portfolios in certain directions when we give our clients equity exposure. So,
Yeah, there's we like to find the pockets of opportunity, and it looks like to us, and we'll get into this a little bit more, small caps certainly look like a great undervalued pocket of opportunity. Now, it doesn't mean that you put all your money in small caps, but if you're invested with us, you've probably seen a small increase in small caps happening over the past at this point year or
year or
so.
so. Yeah. No,
Yeah.
thank you. And with this conversation, we would love to talk about buybacks.
Yeah, so buyback companies buying back their own stock. So announced buybacks, which companies have spoken these figures, but they haven't yet executed because it's not through the end of the year yet. But announcements, we're nearing $1 trillion of company buybacks. That's once it happens, it'll set a record, and there's market support there because if you think about the logistics of a buyback, it's a company buying their own shares. So it's okay if you don't buy their shares; they're going to buy it. And more buyers and sellers moves the stock price up. So this provides market support. That's why we titled it this way.
Yeah. And another reason for market support, which is one of my favorites, is you addressed it when we kicked this off, is the cash on the sidelines.
Yeah, this is for probably 20 years, I've always talked about liquidity, and liquidity is probably the single most important foundational element for the capital markets to succeed, in my opinion, right? Because ultimately, if there's no money and no willingness to lend money because there's no money, then the you know economic wheel stops turning. That's just the way it is.
Yeah.
The capital markets sort of lock up, and if the economic wheel stops turning and the capital markets lock up, that is a terrible scenario, right? We have anything but that scenario today. We have a level of cash that has never been seen before in history, and we thought the pandemic level of cash at about $5.5 trillion was a lot.
I remember when we talked about it.
I mean, it's amazing.
Looks like a blip on the radar.
It looks like just a little blip on the radar. We're nearing $8 trillion in cash, which is just remarkable. It's depressing at the same time because, when we get to peak cash, and we're probably just about there, it may exceed the 8 trillion, but we're really close. It usually happens when rates are coming down. So the yield on that cash is coming down, Meanwhile, cash still comes in, right? It's like a just a delayed reaction.
Yeah.
Keeping in mind, if you look over the past year, various markets, whether it be the bond market or the stock market, are up quite well, and expected to be up quite well for the foreseeable future. But there's still money sitting in cash. So all that opportunity cost is why, when you hear these studies about average investor return over a long period of time is exponentially lower than market return.
Yes.
It's not because you were 2% overweight the S&P 500 or underweight the S&P 500 or underweight international. No, it's because you just made a bad decision and bad timing. It was usually emotionally driven, and you decided to go for safety at 3 or 4% when you could have had a 20% return at a level of risk that mimicked the same allocation over the past 20 years,
Yeah.
right? So this to us, if we keep moving with this chart and it stays high, is going to define why, of course, not our investors, Julina, but why the average investor does not make nearly as much as the capital markets because they exit at the wrong time. They stay in cash at the worst time, right? You always want to invest early in the bull market when you are afraid to invest.
Yes. And we have shared these past studies on these webinars before. It is uncanny. It happens over and over and over again. And yet,
Yeah. Yeah. And, there are a lot of brokerage firms that like to show these charts because they're trying to get their clients out of cash. We don't have that problem. Our clients trust us, listen to us. We invest money well for them. So, our clients don't have the issue. We're just showing this because, if the friends of our clients are saying, hey, I'm not getting that return, well, the
there are a
next,
lot of friends and family still on the
yeah, well,
sideline.
right. So, how much money do you have in cash? All of it. Well, of course, you're not going to get the return. You're not participating.
Yes.
So,
Yeah.
anywho, this is a lot of support being provided for the capital markets. Liquidity is key, and there's a ton of it.
Yeah. No, that's great. Thank you. And it hasn't felt like a lot of volatility this year relative to past years, but we've had some.
Yeah. So again, historical trend of the volatility index. There's a lot that goes into this, but I'm going to simplify it. Yeah, as we approach an election, you unknown outcomes, right? The market doesn't like the unknown, and it prices in things like hedging, or if this happens, we need to be positioned this way for a certain period of time. And what you see is that period of time is usually until there's a defined outcome, and that's usually November, at least when it comes to elections. And you can see then volatility just drops like a rock. And what actually happened this week, the day after the election, is the volatility index did exactly what you see on this chart. It dropped significantly,
It just
just
dropped
about to
off.
the same level. And what does that do? Well, it moves the market higher because many of the negative positions and hedges being put on in a short period of time either have expired or have been unwound,
Yeah.
and will very likely continue to be unwound. And not to get too into the details here, but there are other now that we have the known outcome, there are other positions that will be put on that I believe will be in the direction of a rising market. So
Absolutely.
yeah, so the slightly elevated, bumpy couple of months leading up to the election is normal, and it's usually found in this measurement, which is really pricing in the unknown and how institutions and professional investors price in the unknown. And now it's being priced out, which means we have a boost in the market.
A nice little boost.
Yeah.
And in staying in the conversation of markets, let's transition to bonds.
Yeah. So Kyle, our lead analyst, we love Kyle. We made a mistake. Julina and I removed this slide from the prior presentation. It was a phenomenal slide that we skipped out on, so we threw it into this one just to show the 10-year Treasury yield in a short period of time. The past couple of months has gone from just below 3 to a little over 4. 4.2, 4.3%. And that's a big deal
It's a
as a
move.
percentage change.
Yeah.
But that's exactly what happens this time of year. There's some seasonality to the bumps of the 10-year Treasury. Why do I even talk about this? Well, institutions have this incredible pair trade that goes on where they tie the yield and direction of the yield of the 10-year treasury to the stock market. And generally speaking, as the 10-year rises, the stock market at a certain point will decline, right? There is a pair trade where if the 10-year goes above a certain level and breaks through resistance, then you sell the S&P 500. Regardless of fundamentals, it's just a very silly, this does this, you do that, right?
Mhm.
It's a connected trade. Well, again, there's been some volatility, and a lot of that volatility was also due to not only the uncertainty, but how rates were pricing in the uncertainty, right? Because some of the hedging was done here. And what you see is, well, historically, oh, it's normal. It's this time of year. Of course, the last chart showed the seasonality, and this chart shows you the seasonality of the 10-year treasury. It influences the market. But what you see, just like the volatility index dropping, is you see the 10-year historically having this move up, draw your finger here up from November, and you see, yeah, yields are a little elevated, 10-year, not short term. And then it starts to fall back down, right? So this is just generally speaking, the pricing and repricing of the 10-year treasury seasonally,
Mhm.
really focused on election time and maybe a couple of months after.
Yeah.
Completely normal. We'll likely see it come back down soon, providing maybe even more breathing room for the
Yeah.
market.
Exactly. And in conversation with the bonds, we have to talk about interest rates and where we see it going forward.
How about this? Have we even talked about the rate cut yesterday yet?
No,
No,
we
no.
haven't. Wow,
Well, the Fed had probably the most vanilla meeting they've ever had. I listened to the whole thing. I listened to Jerome Powell's presentation and the Q&A.
you didn't highlight any of the language.
Was, I mean, to summarize it for you. Hi, I'm Jerome Powell. We're going to cut rates like we said we were going to do by a quarter, and the language is about the same. And we'll see you in December.
Yeah.
Have a good day. Goodbye. But I mean, that to summarize it, that's what it was, right? So we're not going to overdo it with all the Fed slides, but they cut rates again, which is technically the third time, keeping in mind the first time was in September, but they did the equivalent of two cuts, right? So you really have three cuts, three 25s, two done at once, 50 in September, 25 in November, and the expectation is still 25 in December. That would be a full point executed, through three meetings. That is what the Fed has outlined. That is what the market is expecting. And, the expectation is still, if you look at this chart, that's what this chart shows, is about another four cuts next year, right? Four to five in essence, which I view as a quarterly cut. I think the market has to understand it's not going to be every meeting that the Fed cuts next year. It's probably going to be a quarterly cut. This is something that we talked about a year ago
Mhm.
as we were kind of reading through how they were framing their guidance,
Yes.
right? So the expectation through our lens, we're just going to say it now, is don't be afraid if they skip a couple of meetings. It's all by design. They
Steady
want
versus
to
aggressive.
they want to do about four next year,
Yeah.
and that means calendar quarter, one per calendar quarter.
Okay.
We think that's exactly what they'll do. If they don't, it might be one more. We think they'll end up doing a little bit more because that will get target rates down to right about 3%.
Exactly. Yep.
So more to come on that as time passes. We will talk about this a little bit less because it seems like the Fed plan is sort of on the conveyor belt, and they're
Yeah.
just going to run through their long-term plan that they articulated. We shall see.
It's about time.
Yeah.
And one of the reasons for the cuts has been inflation.
Yeah, so the dual mandate of the Fed: employment, full employment, and inflation. And what you see here is PCE, which is the Fed's preferred measurement of inflation. I'll just keep it simple. Generally speaking, it is the overarching main inflation index with generic equivalents. So, instead of pricing in Oreos, you can get the Walmart style Oreos, right? Which generally speaking are less money. So it prices in some equivalents, which gives you just a better read of how people actually spend money and the real impact to them. And what you see here is both of those indices, whether it be the main indice or the core indice, they're both in the twos and trending lower. So the Fed sees this as good reason to continue on their path to get rates from where they are to maybe more closely lined up with the rate of inflation, probably plus a point. We'll keep it at that.
Great.
Yep.
And I noticed during this election season that the topic and concern around deficits seem to rise.
Yeah, I mean we've had budget deficits now for 2 decades, but yeah, the size of the deficit is still near the size of the pandemic deficit. So it's it's massive. It's almost $2 trillion.
Yeah.
So the more deficits we have, right? The when we have a gap between what comes in and what goes out, we as people go bankrupt,
Yeah.
right? Or we ask friends and family for help, or we go to a bank. Bank is going to say, "Well, no, you can't afford it. So go ask your friends and family." The government just says, "Oh, great, we'll just borrow more money." Right? We have this. I'm going to call it for now this unlimited ability to just fill the gap with issuing debt. So ultimately, fiscal deficits lead to more borrowing. More borrowing plus higher interest rates equals costly debt. So we'll spend 10 seconds on this chart. On the top left hand side, far left, you see the expense categories. You see the P&L, in essence, of the government, and you see category in royal blue, second from the top, called net INT, net interest. Again, this is backward looking. If we update it for today, it's about $1 trillion expense and growing. That is interest. That is just the interest expense on the debt that we have accumulated, and that's not going down anytime soon. It will be going up.
Right.
And you see on the right the deficit. So, I mean, look, I don't want to get too cute here, but we're borrowing money to pay interest on borrowed money
Yeah.
and other things.
Yeah.
And I think if you apply that to the business world, that that is what chapter 11 and chapter 7 in the personal world are for. You file bankruptcy in that case. Look, we have this unique ability to print money and for those to hand us money in exchange for an interest rate, guarantee liquidity, and probably some other benefits. And we'll continue to have that. But at some point, we do have to have a conversation about how we spend money, where we spend money, and cutting back.
Yeah.
At the same time, the tax side of it, very tough to do. Again, these are election losers, right? You tax people a lot and you cut back on entitlements, you're going to lose an election. So it usually, when you see significant changes in the past, which there haven't been many, to these major policies, it's usually a second term president that does it. It's just like you're not going to get back into the office. You're going to, if you were even trying, you would lose, right? So you just have to take one for the team, which is the United States of America and its finances, and you make the hard call and you figure it out.
Yeah.
I think there's actually a real chance that that happens under this administration. Again, the setup is pretty good. There's a high need, and it's the last term
Right.
of this president. So, we shall see what happens, but something's got to give. And both sides have to come together to figure this out. And we'll cover this more in detail in the coming quarters, but we figure we would flirt with it right now.
Yeah, and I think a lot of this information on the page just summarizes how delicate of a balance this conversation is.
Yeah.
And let's talk about this idea of the cost of a cumulative inflation.
Yeah. So here we're winding up to sort of define the outcome of the election. And this is one of the subtle slides. So the cost of cumulative inflation equals low consumer sentiment. Keep in mind, everybody is more sensitive to expenses than they are to asset valuations and income, right? We are humans, and that's the way generally we are wired. We have this myopic loss aversion where if you ever lost money in the markets, you remember it, but somehow you forget that you make money in the markets 90% of the time, right? We hyper focus on bad days, bad quarters, bad years. We remember where we were at the peak and we only talk about what we got down to. And
Oh,
if we
yeah.
got back to the peak,
Yeah.
it's like, oh my God, but you make money all the time. We're very sensitive to loss aversion, and loss aversion is also expenses, spending money, right?
Yes.
Money coming out of our bank account. No one likes to spend exponentially more on a turkey sandwich or college tuition or an Uber ride. How about that for being modern, Julian? I didn't say taxi or a cab, right? Or an
I
Uber
know.
ride,
Yeah.
or for rent or for childcare. How about childcare?
Astonishing
Childcare and
right now.
housing. I mean, that's amazing, right?
Yeah.
And healthcare and everything else. So this country and most people on this planet are very sensitive to much higher expenses. Everyone can tolerate 2 or 3% more, 25% more, 30% more in a short period of time is going to lead to something. And what
Hmm.
it leads to is a sour consumer and low consumer sentiment. And
Yes.
low consumer sentiment shows up in the polls this way. How do you feel about the future? Awful. How do you feel about your current financial situation? Awful. Now, for those who have assets, you have to balance out the higher expense with the much higher asset level that you have, but you don't. When you're asked that question, you just remember that a scone now costs $6 and not too long ago it cost 3,
Exactly.
right? So here is your low sentiment side by side, low consumer sentiment with low small business sentiment. Now, I can tell you, if you've been paying attention, the Federal Trade Commission, the FTC, the current crew that is heading up the FTC is trying to block all mergers and acquisitions. And that is very anti-business. And many of these mergers and acquisitions are there's two parties. There is the company that is acquiring, usually a bigger company, and a company that's being acquired, a smaller company. Now you have to understand small business. Small business and small business owners, and many of the employees at small business, they aspire to be a bigger company, right? That's growth. And sometimes they aspire to be taken over by a bigger company, right? That's just how it works. If a small company is willing to be acquired and it's not some type of, takeover, then they see that as a value add for their business, their clients, themselves, their staff, so on and so forth. When you have the government suing both parties, wasting tax dollars and wasting business dollars in delaying these things, you have very low small business sentiment, right? There are other things that fall into small business sentiment, like wholesale good prices, the inability to hire, HR issues now that are a little different than they were in the past. So you have incredibly low small business sentiment, lower than pandemic
I would,
sentiment.
I was just going to bring that up.
I
Yeah.
mean,
It's
how does
touching
it
around
get
the financial crisis.
how does it get lower than the world is closed? But it's lower and very low, near pandemic low, at financial crisis level,
Yes.
consumer sentiment levels.
It's
You know,
astonishing.
yeah, the church wouldn't let the Pope in if there were an election, if he had these numbers. You know what I mean? So sentiment means a lot, and it shows up in the polls, and it usually shows up in the voting booth as well. So here it is. We want to hyper focus on this. Now, what we should also say is that historically, you want to invest when sentiment, which are also expectations, are very low. It
Yes.
tends to be a very wise move. When sentiment is this low, it usually means that optimism is right around the corner, and that
Exactly.
just compounds quickly on a firm upward slope.
And
So
there have been multiple studies of this going back decades that show when sentiment is low, that is when you want to be in the market.
yeah, and I'm sure no one's going to remember this, and Julina, you may not either, but in November of 22, when we called the bottom of that brief bear market, one of the slides that we put out there was maybe a better version of this, where we put the market and the sentiment level together,
I remember.
right? And we circled it and said, of the many buy signals that we had and have, and again, we executed on this stuff. One that we felt very strongly about was this sentiment indicator, which is
Yes.
bizarrely accurate. And it really showed that these major dips in sentiment, you could actually see it on the bottom right-hand side above 2022.
Mhm.
We bought that, and it has worked out quite well. So, it has dipped back down from where it was maybe 6 months ago. We think there's reasons to be optimistic based on these levels. They probably
Yes.
won't go much lower than here.
Yeah. I can't remember what I had for dinner last night, but I remember that slide because it's been one of my favorites for a long time.
Yep.
So let's round this out. Our everything else topic is around the election.
Yeah. So, the wind up with the sentiment levels, consumer sentiment, the realization of higher expenses by all throughout the country, regionally, everywhere, has led to this, right? Ultimately, has led to this. Look, there's nothing else to say other than this was a full participation election where Republicans didn't do this themselves. It's impossible. The numbers don't work. You had much of the middle and much of the left actually have to participate in this outcome. That's just the way you look at it. And there's the electoral votes and the makeup on the left hand side of this chart, which paints a certain picture. But actually, when we were shocked when we zoomed in, this is the county map. We didn't. It's not designated by county, so you don't see the small little squiggly lines.
Mhm.
But when you look within the state, so if you open up the states, this is more of an X-ray on the right hand side. You see some really interesting things. Most of the country is red. And even in the blue states, I mean, look at California.
A lot of red.
California is half red.
Yeah.
Half of it is red. So that's a major change. Colorado and New Mexico, major pockets of red. Even in Connecticut, hard to see. You really have to zoom in, but there's some red there.
Yes.
So I just think it's very interesting to look at this. There's a lot that you can take away from this, and it's just something to be mindful of. So
And yet this was coined the most important election of our lives.
yeah, well, they're all important, right?
Yeah.
The most important election of our life in our lives is always the next one.
Mhm.
Just keep the tagline going for every election because it's always the most important election of our lives. But when it comes to the capital markets, it historically doesn't really matter, right? So look, certainly socially, depending on the way you lean, there's a party that is unhappy today, as unhappy as the party that was unhappy 4 years ago today. And that's just socially how it's going to switch, right? It,
Yeah.
it, it is what it is. We just want to make sure you understand that when it comes to the capital markets, yeah, there's some tweaks. The rule book change a little bit, some policy change, some tax change, but businesses figure that out, right? If you change the rule book, you quickly figure it out. Kids nowadays are taught math in a very different way, and they're figuring it out. Now, for me, I still can't figure it out. But ultimately, it's a new rule book, and companies that make up the capital markets, businesses that have to factor this stuff in, they do.
Yeah.
And they figure out how to navigate with the new rules and they move on. And it's as simple as that.
Hmm.
So, I don't see when it comes to economic policy severe changes one way or the other. Of course there are going to be changes. It's new administrations have their agendas and styles and way of thinking, but ultimately, historically, it has always worked out quite well for both sides.
Yes.
So, deep breath. Certainly, when it comes to the capital markets, we're on this for our clients. There's nothing they have to do. And we mentioned earlier that we have already invested in some of the themes that we thought would likely be investable themes like small caps, like being underweight foreign stocks versus US stocks, right? Some key themes now that are very likely to be seen under this administration. We've already done that.
Hmm.
So there's not much you have to worry about other than your health and your family and yourself and where your next vacation is going to be, how are you going to live your life, worry about losing your primary care doctor like I just did to retirement. It was a great primary care doctor. I'm looking for one. So any recommendations, I'm open to it, Julina. Take a deep breath.
Yeah.
Take a deep breath. It's holiday season. Celebrate with your family. Talk to your friends. Shake hands. Give each other a hug. Your friendship, your relationships are way more important than changing policies in what the media is telling you. just get out there and be happy. You have one life to live. Make sure you live it in the best, most positive, most rewarding way possible. And that usually means together with people. And that is my advice for everybody.
I think that's a great way to end. The only other comment I was going to make is that, if we are in fact in the beginning of an extended bull market, we may be continued on these webinars for years to come,
Years to
ending
come.
with enthusiasm, and I hope that's the case.
Yeah, Julina, someday you and I are going to have white hair and we'll be doing these. Yeah. So
Sure. Well, thanks as always, Bob, for the insight. And to everyone that's listening, as always, if you have any questions, please reach out to us here at Principal Wealth. Happy
great.
holidays.
Yeah. See you next month.